Which one's better?
Yours is better. It's brighter.
I still think that we should do a timer.
Alright, I'm doing it.
Yeah, definitely timer.
Because this doesn't say anything.
Alright.
All right. 1, 2.
Oh, wait. Alright, I'm ready.
Bro.
See like this. Alright. You guys ready? I'm doing the countdown.
All right.
1, 2,
Three.
3. Good afternoon and thank you for having us today. We're here to talk about O'Reilly Automotive. We initiate a coverage with a buy recommendation with a target price, with a 12-month target price of $117 with a 24% upside. Now, we believe that there's 3 main reasons why this is a buy recommendation. First, it's the irreplicable distribution advantage. Second, the market is highly fragmented. And third, O'Reilly has shown capital discipline, supporting the return on invested capital. Now, O'Reilly operates in the global automotive aftermarket, with 6,000 plus stores across the United States, expanding into Canada and Mexico. The estimated market is about $170 billion. Now, O'Reilly serves both DIY consumers and professional installers with a dual market approach that is very well balanced. And now this is important because the do it for me relies on the time sensitivity demand, which prioritizes speed and availability over price. Now this reduces earning volatility and supports margins volatility.
So 3 components driving the demand. First one, aging vehicle fleets. Second, rising vehicles might travel, and the third one, affordability pressures. And those components combating with each other. The U.S. fleet is aging 12.6 years on average in 2024, up every year since 2012. And older vehicles mean breaks down more. We need more parts more frequently. Vehicles over 8 years cost $2,000 to maintain per year, 3 times more than a new one. So this is non-discretionary, and O'Reilly Deep SKU was built exactly for this. Usage is also high. Vehicles might travel experienced a dip in 2020 because of COVID, and then rebounds back at 3.28 trillion in 2024. That's mean more miles, more accelerated wears, and increasing directly replacement parts. Work from home didn't reduce driving. Even though work from home doubled post-COVID, vehicles might travel still at 5% above 2019. So that's mean leisure driving and immigration surveillance fill the gap. New vehicles prices jumped from 39,000 to 48,000. Because of that, people choose to keep their vehicle instead of replacing it. So they try to repair instead of replace because of the high cost. So that will sustain both DIY and professional demand installer.
Now, when it comes to the first pillar, the irreplicable distribution advantage. Now, O'Reilly operates in a hub and spoke model that is supported by 31 distribution centers, and this makes fulfillment easier, supplying its network from the same day to the next day fulfillment. Now, this is very important because demand is driven by speed and availability, which O'Reilly is well positioned to be there. Oh, that's me?
Yeah.
I fucked that shit up. I already said that.
Oh, okay.
So
okay.
for pillar 2, the fragmented market and share gains, as you can see right now, the Big Four holds about 44%. That means this market is not consolidated, and those competitors cannot compete O'Reilly because of what? O'Reilly have a big hub and spoke network, deliver over 150,000 SKUs, same day or next day delivery. People also shop on parts, not on price. So that's how O'Reilly wins the share. As you can see, the financials speak for itself. Revenue CAGR outpaced peers, and the industry leading earning per shares growth drive premium P ratio.
So moving on to our third pillar, we have disciplined capital allocation and superior ROIC. So to begin with, O'Reilly's has a O'Reilly's has an industry-leading return on their invested capital. This is evident on the graph on the left, in which they have a 32.1% ROIC, which is stronger than all of their peers, and this is also consistent over the years, as we can see on the graph on the right, which shows steady growth in their ROC rates over the years. So moving on, we have the disciplined capital allocation, which reinforces their competitive advantage. So O'Reilly reinvests their return capital into their stores for more revenue, which is shown by their steady growth in store count over the years. And they also have a 25.40 positive spread. And they also have a great PE ratio on the left of 33.2 in 2024, which is above industry average, which reinforces the notion that the market has strong confidence in O'Reilly to generate great returns on their invested capital.
Looking at the Food Field valuation chart, we can see the comparables from $94 to $103, and our DCF is from $105 to $125, supported by analyst consensus from $91 to $125. Also, we have WACC at 6.7% and labor beta at 0.63%, which shows that O'Reilly is safer even during the recession and will have a steady growth with them. Moreover, when you look at our historical revenue data from 2022 to 24, we can see 7.7 CAGR, and with that we forecast 3.0 CAGR from 2025 to 2029. And if we look at the EBITDA margin, it was 23% and it did at 22%, but we believe it's going to go up to 23% again because of the irreparable distribution and huge number of store counts. And moving on to the sensitivity table, we can see at 6.7% with growth rate at 5%, it is at our target price of 116%. But even if we increase the WACC to 7.2% at the same growth rate, we can still see that it's going to be at $89, which is almost equal to our trading comparison data. And we took the terminal growth rate at 5% because of the report that said that the O'Reilly is going to be having a revenue up to $664 billion by 2028. But to be conservative, we reduced it by 1%, making it to 5 to 0%.
Okay, so moving on to our Monte Carlo, we're doing 50,000 simulations that shows those upside skewed. We had a mean of $141, which was significantly above our target price, as well as a 25th percentile, lower percentile of $119, which is also above our target price. This clearly shows that our Monte Carlo simulation strongly supports our target price, if not a price even higher than what we have. So moving on to ESG, we constructed our own scorecard of a scale of 0 to 5, and it clearly shows that O'Reilly demonstrates broad-based ESG leadership versus their peers, leading in E score, G score, and being industry standard in their S score. This leading to a total of 4.0, which is well above their industry peers. So why is this so high? Environmentally speaking, they have a great focus on their scope 3 supply, which leads to market stability. Socially speaking, they have great labor stability and solid relationships, which leads to revenue durability. And governance, they have great board oversight and capital discipline, leading to high ROIC plus equity outperformance. So focusing more on environmentally, O'Reilly has a great focus on their scope 3 because they believe that's the most material driver. The auto market as a whole, at least for the US, has a great concentration in Mexico and imports, but they also have significant presence in China, which is a high risk area. O'Reilly's mitigates the risk caused by this concentration by having a great diverse global supplier footprint, as well as targeted emission reductions and great resilience and transparency when it comes to that, reducing their cost disruption risk while making sure the environment's good too. So socially speaking, they have great labor stability leading to a stable workforce, strong and solid relationships, which leads to repeat demand. And I believe this is best represented in the 2022 to 2024 revenue CAGR versus peers, in which they have an industry-leading 7.7%. So moving on to governance, which I believe to be their strongest aspect, they have an independent and experienced board that have incentive alignments, so low base wages and high bonus wages depending on how the stock is doing, and disciplined capital allocation, all leading to sustained shareholder value. This leads to, I believe this is best reflected in their index share price graph, which shows that they quadrupled their 2019 stock price over the course of 6 years into 2025.
Now, when it comes to risk assessment, there's structural and macroeconomic risks. First is the structural risk, which is, first of all, the EV adoption, which poses a long-term structural risk when it comes to less moving parts. But O'Reilly is well positioned to mitigate this risk by the ICE fleet increasing and expansion into EV assortments. Now, for the AVs, technological and OEMs, adoption, supply, parts may be shifted towards the dealership network, but O'Reilly is ready to mitigate this by advanced diagnostic tools and diversification. And now for microeconomic events like tariffs, that may pressure cost, but O'Reilly is ready to mitigate this by a dense distribution network as well as the diversification of private label sourcings. And for the market risk as interest rates, economic and weather conditions, this poses a short-term volatility, but demand will remain resilient. Thank you.
So, so after first part, we have like 9 minutes left.
No, we had a minute left.
Yeah, you have like 1 minute left, and you would be like.
You had a minute 20, and I know why. It's because when you're looking like you're like stuttering. I feel like you're scared to look at the graph. You can look at the graph. Don't look at the book. The book's not gonna be here, right? So like, and when we're actually presenting, you're gonna be like,
Practice more.
yeah.
So wait, I had a minute?
Right,
Yeah.
right.
Right.
You have like.
And I
a
took
big-
what?
big-
You went a minute 20
You're going?
for this, yeah. So
I'm back. 1 minute.
I can make
We can-
ESG go really fast. I can lock in really hard on this. If you want, I
Hello,
can stay late and I can practice
Isaac,
with you just this
or
section
a
going
big-
after me. I don't care. Because really, the other section is fine. Just look at the fucking thing. You remember how you said like you want to stand up in this shit? Don't do this shit. Don't do this shit for as long as you can. But the second you start like, okay, what am I talking about?
Isaac
Fucking
is a
look,
bitch.
bruh. Look,
Isaac
like especially because you looked at your book, you were confused about the mitigations.
motherfucker
You can
on
literally
the
just like
Just look back
look
and
see
here.
it.
You have it on your slides, bruh.
See this motherfucker.
You want to redo this slide? You want to